There is a major global trend unfolding in the gold market that most people don't fully understand, and the consequences could reshape the financial world. In 2025, gold prices have soared to record levels, trading well above $4,000 per ounce and marking one of the strongest annual performances in decades. A rally fueled not only by investor demand, but by strategic accumulation at the highest levels of global finance. According to major forecasts, gold could climb even further, potentially approaching $4,800 or more per ounce by late 2026 as central banks and institutions continue to buy aggressively. To grasp what's happening, we need to recognize that gold today is treated much differently than it was just 10 years ago. Historically, gold was primarily a hedge or store of value in times of crisis, but now it's becoming a core strategic reserve asset, one that nations are actively positioning for as geopolitical tensions rise and confidence in traditional fiat currencies wavers. Central banks aren't just buying gold as a backup plan, they're making it a centerpiece of reserve strategy. This shift didn't occur overnight. For 3 consecutive years, central banks have acquired more than 1,000 tons of gold annually, far above the decade average of 400 to 500 tons. In 2025 alone, official sector purchases by central banks have continued at an exceptionally strong pace, with reported net additions continuing to accelerate. Emerging market central banks, like those in Poland, China, India, Turkey, and others, have been especially active, building their reserves against a backdrop of economic uncertainty and the desire to reduce exposure to dollar-based assets. The first phase of this trend is strategic accumulation, rather than announcing their intentions. Many governments and official institutions have been quietly buying gold, sometimes far more than their published figures indicate. Poland's National Bank, for example, led global buying in 2024 with substantial ton-level additions and continued through 2025 with aggressive accumulation programs. China's central bank has also steadily increased its holdings month after month, adding tens of tons and remaining one of the largest buyers globally. India's reserve accumulation reflects a similar strategy, with the Reserve Bank steadily increasing gold reserves while repatriating stock from abroad for security and control. This silent buying isn't random. Central banks perceive gold as a hedge against inflation, currency depreciation, and geopolitical risk. The World Gold Council's 2025 survey of central bank reserve managers shows that about 3/4 of surveyed institutions expect to increase their gold holdings over the next 5 years, while many anticipate reducing US dollar allocations. Nearly all surveyed banks believe global gold reserves will grow, underscoring the broad consensus that gold is a strategic asset in a world of financial uncertainty. Gold's role within reserve portfolios has grown so significantly that it has replaced the euro as the world's second largest reserve asset, with roughly 20% of global official reserves held in gold, up from around 15% just a few years ago. Only the US dollar remains larger, but even there, the dollar share has been gradually declining as gold's share rises. The second phase of this trend is market fragmentation and tightening supply. While gold exports aren't banned internationally in the way some commodities have been restricted, the net effect of widespread accumulation is that less gold is available for open market trading. Central banks holding on to newly mined gold reduce the supply accessible to investors, jewelers, and bullion markets. This dynamic creates upward pressure on price and can distort the normal mechanisms of price discovery that depend on freely tradable supply. At the same time, institutional demand has surged. Investment flows into physically backed gold products, including gold bars, coins, and exchange-traded funds, hit record levels as retail and institutional investors alike sought to position ahead of further price moves. In countries like India, rising gold prices have even shifted consumer behavior away from traditional jewelry toward investment-grade gold bars and coins, reflecting broader recognition of gold's role as a financial asset rather than a cultural ornament. The third phase emerging now is price escalation and potential market controls. Gold is not just rising in price, it's becoming deeply embedded in the strategies of central banks and sovereign wealth funds. It's because new gold mine supply cannot be easily increased in the short term, and recycling contributes only marginally. Physical supply remains constrained even as demand expands. Analysts now argue that the combination of central bank demand, investor flows, and geopolitical hedging constitutes a structural shift that underpins higher prices well into 2026. But it's not just about price, it's about availability. In other resource crises, oil in the 1970s or rare earths in the 2010s, supply could eventually be increased or substituted. In the gold market, such escape hatches don't really exist. New mining projects take years or decades to bring online, and existing mines struggle to expand output in the face of rising costs and regulatory challenges. The structural supply-demand imbalance means that any prolonged trend of accumulation will squeeze available inventories, pushing buyers into a competition for physical metal. What's driving this? Part of it is geopolitical risk. When global tensions rise and the possibility of sanctions, as seen with Russia's frozen reserves after the Ukraine conflict, becomes real, physical gold becomes a safe haven that cannot be easily frozen or manipulated like financial assets. This has only strengthened the conviction among reserve managers that gold offers monetary security beyond what dollar-based assets provide. Another driver is inflation and macroeconomic policy, with central banks around the world facing pressure from inflation and the consequences of expansive monetary policies. Gold's appeal as a hedge against currency debasement has never been stronger. When real interest rates are low or negative, gold's opportunity cost diminishes and its attractiveness increases. This dynamic has helped fuel strong institutional demand alongside central bank hoarding. For investors and policymakers, the implications are significant. If gold continues to play an increasingly strategic role in global reserves, it could herald a reshaping of financial architecture, where traditional reliance on the dollar is gradually balanced by a multipolar system of reserve assets. Emerging market central banks have been at the forefront of this shift, signaling a broader reconfiguration of global economic power that places greater emphasis on tangible assets like gold. So what does this mean for you? Understanding that gold accumulation by governments and central banks is not a short-term phenomenon, but a long-term rebalancing of monetary strategy allows you to see beyond headline price moves and appreciate the structural forces at play. Whether you're an investor, a student of global finance, or simply someone interested in how money and power intersect, this trend has deep implications for portfolios, currencies, and financial sovereignty. If this perspective changes the way you think about gold markets and global reserve strategy, subscribe for deeper analysis of how these forces are shaping the future of money, power, and strategic resources.